Hello everyone, it's a pleasure to introduce Trade Finance Africa, the first platform for trade finance in Africa. Adapting to the new trade finance in the African continent. Trade Finance Africa. 1. Introduction. What is trade finance? Trade finance is the bridge of trust between a buyer and a seller in cross-border trade, because the buyer fears paying and not receiving goods, and the seller fears shipping and not getting paid. Banks and insurers step in. They step in with tools that make the exchange safe and predictable. Why it matters in Africa? Many trades face higher risks: currency swings, limited credit information, logistics delays, and policy changes. Trade finance helps African firms buy fertilizer or machines on time, and it helps exporters of cocoa, gold, oil, tea, textiles, or tech services get paid securely. LC in simple words. A letter of credit is a bank-backed promise. The buyer's bank promises to pay the seller as long as the seller shows the right shipping documents like the bill of lading or invoice. Think of it as a locked box. When correct documents go in, money comes out. Now let's look at Africa's key trading partners. With Europe and the UK, trade focuses on machinery, vehicles, and pharmaceuticals, alongside exports of energy, metals, and agriculture. China and Asia provide essential equipment, electronics, and construction materials, while importing African oil, minerals, and crops. The Gulf region is a major partner for fuel, petrochemicals, and food trade, often involving large project contracts. Intra-African trade is growing rapidly under AfCFTA, with more regional flows of food, cement, services, and logistics. Artificial intelligence is about to change the game entirely. Automated document checks using OCR and predefined rules will significantly reduce letter of credit errors. We will see much better fraud screening and more precise vessel and cargo monitoring. AI also enables faster KYC, AML, and sanction screening decisions. Finally, it allows for data-driven pricing for confirmations and receivables finance. 2. Core trade finance instruments. Let's explore the simple, practical explanations of these essential tools. We start with the letter of credit, including sight, usance, transferable, and standby variants. A letter of credit protects the seller against non-payment and gives the buyer confidence that goods will be shipped correctly. The key parties involved are the issuing bank, the advising or confirming bank, the applicant, and the beneficiary. The process starts when the buyer applies, the bank opens the LC, and the advising bank authenticates it. Then the seller ships the goods and presents the documents. Once the bank verifies them, payment is released. For example, a Lagos importer buys packaging machines from the EU. The LC is confirmed by a South African bank. Common challenges include document discrepancies, shipment delays, and foreign exchange bottlenecks. A sight LC pays immediately once documents are compliant. A nuisance or deferred LC pays later, often at 90 days. Transferable LCs allow the first beneficiary to transfer the credit to others, which is perfect for traders. A back-to-back LC involves two separate LCs used when a trader needs to buy from a supplier before being paid. Revolving LCs automatically renew for repeat shipments. Finally, a standby LC acts like a guarantee, paying only if the buyer defaults. 2.2 Letter of Guarantee. This is a bank's promise to pay if the applicant fails their obligations, covering bid bonds and performance bonds. For example, a Libyan client hires a Turkish contractor who provides a performance guarantee counter-guaranteed to a Libyan bank. 2.3 Documentary collection. Banks forward shipping documents against payment or acceptance of a draft. It's lower cost, but less secure. 2.4 Bills of exchange. When a seller draws a bill on a buyer and it's accepted by a bank, it becomes more secure and discountable. 2.5 Trade credit insurance. This covers non-payment risk due to commercial or political issues, supporting open account terms. 2.6 Pre-shipment and post-shipment finance. Funding before shipment for materials and after shipment while awaiting payment. 2.7 Export credit facilities. Support from DFIs and ECAs to finance exports through buyer and supplier credits. 2.8 Supply chain finance. A buyer's stronger credit helps suppliers get paid early at lower rates via a platform. 2.9 Factoring and invoice discounting. An advance against receivables very useful for services and SME exports within Africa. 2.10 Forfaiting. The non-recourse purchase of medium-term receivables common for capital goods. 2.11 Islamic trade finance. Using murabaha, where the bank buys goods and sells at cost plus profit, or the agency-based wakala model. 2.12 Avalized bills and bankers' acceptances, adding a bank's guarantee to a bill to enhance its discounting potential. 2.13 Import and export loans, short-term loans for trade cycles, subject to local foreign exchange access. 2.14 Guarantees for public contracts. Performance and retention guarantees required by African public works and state enterprises. 2.15 Digital trade instruments, ELCs, blockchain collections, and regional settlement systems like PAPSs to cut cost and time. A quick tip. If you are new, start with LC at site or DP for trusted buyers. Add a confirmation if the risk is high. 3. Regional overview. Algeria in the north has state-guided imports and a strong role for public banks like BEA and BNA. Libya's central bank manages FX allocations, often using foreign correspondents like Bank ABC for confirmations. Egypt has a large banking sector with strong LC know-how, where Afreximbank is particularly active. Morocco and Tunisia serve as export hubs for auto parts and agriculture, with banks like Attijari Wafa active regionally. Nigeria sees high LC volumes in oil and gas, although foreign exchange scarcity and bottlenecks remain a challenge. In West Africa, trade revolves around cocoa and gold, often using CFA franc settlement through UEMOA rules. Central Africa relies heavily on European confirming banks for its exports of oil, wood, and metals. East Africa features strong regional banks and rapidly growing mobile digital rails for infrastructure and agri-trade. South Africa acts as the regional hub, with major banks confirming LCs for mining and equipment flows. Across the continent, shared challenges include currency volatility, heavy documentation, and infrastructure delays. 4. Intra-African trade versus global trade. Intra-African trade usually involves smaller tickets and regional rails like PAPSs. Trade with global partners is larger in value and involves complex logistics, USD dominance, and strict sanctions checks. For example, Nigeria might export equipment to Côte d'Ivoire under AFCFTA using an LC advised through Ecobank, or an Algerian importer buying Italian machinery using a confirmed LC with a 180-day usance period. In Libya, Turkish contractors often use performance guarantees for infrastructure projects, with payments linked to milestones. Finally, a Senegal telecom project might use a standby LC to secure completion in favor of a government agency. Thank you for joining us. Visit tradefinance.africa to stay ahead in the world of African trade finance.